Okay, is everybody ready to get started?
Yeah.
Okay, perfect. I appreciate all you guys, everybody showing up. Honestly, I'm kind of shocked. I thought we'd have like 2 people here. It's late. We're all tired. It's been a rough couple of days. I'll try not to bore everybody. So that's the goal. Oh, awesome. Well, good. Hopefully I don't disappoint. It's a really, really tough time slot. It's my own fault, though. I run a little brokerage firm, and so I really have a hard time getting away from the desk during the day, so I always take the classes that are scheduled beyond market hours. So it's nice for my day job, but it's tough when it actually, 5 o'clock and we're talking about trading futures. It's actually fitting, though. The futures markets, as you know, trade basically 24 hours a day, so I should be used to it. I shouldn't be complaining. Anyway, my name is Carley Garner. I am a commodity broker. We trade, we deal in futures and options on futures. If you have any questions, comments, concerns, you can reach me at this contact information. You should also have a pamphlet with this info on it. And our website's carleytrading.com. Even if you decide futures trading is not for you, and trust me, that's okay, it's not for everybody. But even if you don't necessarily get to the point where you want to trade, you can at least go to our website and learn about it. There's all kinds of good information, videos, articles, all types of fun things. And if you're on social media, Twitter, Facebook, Instagram, if you just search either Carley Trading or Carley Garner, we'll pop up. I warn you, I post a lot of pictures of my dog. I probably drive everybody crazy, but she's cute. All right, so I mentioned I'm a broker, but I'm also a contributor to Jim Cramer's Mad Money. If you've ever watched Mad Money, we contribute to the show roughly once a month, sometimes more, sometimes less. We give them ideas on different commodity markets, gold, crude oil. Sometimes we do the S&P, which is what we're going to talk about today. For those brokerage clients that we have, I do write some in-house material in the form of newsletters. We give trading recommendations, ideas, commentary. I can't guarantee the recommendations are always going to make money, of course, but we've been doing this for a long time, and we've learned a lot of lessons, many of them the hard way. So we try to help our clients steer clear of some of the common pitfalls. If you're a little more tech savvy, we have a mobile app, Carley Trading. Just search in your app store. It's free to download. Most of the app is free. You don't have to pay anything or subscribe or be a client of ours. There's news feeds, video feeds, all kinds of nice things. If you are a client of ours, you will have access to restricted content, which again includes the recommendations and things like that. It actually has, if you are a client, it actually has pop-up notifications that'll tell you what, if a recommendation's coming out, why we think something might be a good idea, that sort of thing. And you can even sign up for a trial of that. So if you're not a client, you don't want to be, that's okay. But you can sign up for a trial and test it out. Last plug, I've written, can everybody hear me in the back? Okay, just making sure. All right, so I've written 4 books. I've written most of them more than once. There's several editions. If you do decide you want to buy one, they're cheapest on Amazon, but you can find them at any book outlet. Make sure you're getting these colors as far as the covers go, because the different editions have different colors. These are the newest. Okay, let's get started. One last thing I want to make sure everybody understands. This is risky. We are trading. We're speculating. There's no easy money. We're not earning dividends or interest. We're trying to beat the markets, and it's hard. It's not impossible, but it is hard. How many of you are here currently trading futures? Okay, quite a few of you. All right. So most of you probably know this, but we're going to go over this real quick. Why trade futures and options on futures? When I say futures, I'm actually talking about both futures and options on futures. I'm lumping them together as a category. Most traders basically tend to look for what's familiar or what is convenient. And so what happens is if they're looking to trade commodities, they generally kind of flock towards ETFs, GLD, UNG, USO, those types of things. The reality is those are relatively not the right word. They're actually extremely inefficient, because what they're doing is pooling investor money, and then they're going to the futures markets and buying futures contracts with the pooled money. And of course, there's advisors and rebalancing costs and contango and all kinds of things that are messing the efficiency up. So if you really want to trade commodities or futures, such as the E-mini S&P or anything like that, speculatively, again, these are not investments, these are trades, it's speculative. You're really better off doing it in the futures market, and so hopefully we can convince you of that, or at least educate you in the risks and rewards, and you can decide for yourself. By the way, the reason we hand out pamphlets, the slides are pretty wordy. I know that's against all the rules as far as presentations go, but I'm a better writer than a speaker, so the words are for me. You don't have to feel like you have to read them. They're just to guide me along the way. So the great thing about futures trading is it offers around-the-clock trading. 23 hours a day, the futures trading is going on. Some markets close for longer than that. For example, the grain markets aren't open 23 hours a day, but most of them are. And the great thing about that is, if something happens in the overnight session during, in Asia or Europe, or the U.S. election in 2016 was pretty wild, somebody that had a stock account would have not been able to react to anything that's going on. Someone that has a futures account can react in real time. Futures offer free leverage. It's basically a margin account at no cost. So if you're trading stocks and you want to trade on leverage, you have to borrow shares from your broker, or if you want to short a market, you have to borrow shares from your broker to short them, and then your broker is going to charge you interest. In futures, it's not like that. You get leverage without paying for it, no interest. You don't have to borrow shares. If you want to go short, you just simply sell. You click a button and you're short. So these are all obviously great advantages to trading futures, but keep in mind leverage can also work both ways. So leverage isn't always great. Sometimes it's horrible if you're on the wrong side of the trade. As a side note, though, most people assume that you have to just automatically use all the leverage that the exchange is giving you, and that's absolutely not true. You as a trader can determine how much leverage you want to use. If you're risk averse and you don't want to risk your entire account on one trade, you don't have to. You can overfund your account. You can trade a smaller product, and we'll talk about some of those things today, actually. Such as, were any of you here for the opening day? There was a panel that I was on to talk about the micro futures that the CME listed. So in general, they're basically really tiny, thus the name micro, really small futures contracts. One micro S&P represents about $14,000 worth of stock. The margin's only $1,000. So you can see there's leverage built into it, but you don't have to use that leverage. If you traded one micro in a $14,000 trading account, you would actually eliminate all the leverage. So that way you as a trader can decide how much leverage you actually want to use. The more leverage you use, the more money you can make, but the more money you can lose, obviously. The purpose of today's class is we're actually going to talk to you about how to manage the leverage in a different way using options. So just as a primer. I kind of mentioned this, but I'm going to mention it again. In futures, you can buy or sell in any order. If you think crude oil is going down, you just sell it. It's that easy. There's no delay, no waiting for your broker to give you crude oil to sell. You don't have to own it. You just sell it if you think it's going down. Some people are shocked to find out that you can open a futures account with about $2,000. The minimum at our brokerage is $2,000. I know there's actually brokers out there that have lower minimums. I'm not saying you should necessarily do that. If you open a $2,000 account, there's really only a couple of products that you have any business trading in that size of an account, but you can do it. Actually, the product we're going to talk about today, you could trade in a $2,000 account, and it would actually be almost reasonable. But for most products, like if you were looking to trade crude oil or natural gas, I would not recommend doing it in that small of an account, but in theory, you could if you wanted to. Futures have favorable tax treatment. Anything that you trade in the futures, whether it's options on futures or futures, is going to be taxed at a 60-40 blend between long-term and short-term capital gains rates. So you're actually going to pay less taxes. This assumes that you're making money. If you're not making money, then unfortunately, it's actually a tax disadvantage to trade futures. But if you're making money, there's an advantage to futures over stocks. And it's also a lot easier to report. If you're trading stocks, you have to report each individual trade to the IRS, and it's a complete nightmare. If you're trading futures, you only have to report one number. You either made money or you lost money. That's it. It's really simple. Yay, yeah. And futures trading is really exciting. That's probably why we're all here. I tell this story over and over, so if you've already heard it, bear with me. But I once saw a trader take a $10,000 account to $500,000 in 2 weeks. And how he did it was, right before the S&P collapsed in 2008, he took all $10,000 that was in his trading account and bought as many put options as he possibly could, deep out of the money puts. Honestly, I thought he was a little crazy. I had no expectation whatsoever of him making money on it, and he did. It was awesome. So he turned $10,000 to $500,000, but then unfortunately he gave it all back. And the whole process probably took about 4 or 5 weeks. So up and down. He's taken some time off. All right. Okay, so everybody wants to talk about day trading. To be honest, this is my personal opinion. Day trading is probably the hardest way to make money. It's really hard. It seems easy if you pull up a chart and you think, geez, the S&P was down 80 points on Monday. That would have been so easy if you just sold, bought it back, sold the high, buy the low. It seems so easy, right? It's not. It's frustrating. So, but because day trading has, most brokerages, at least most futures brokerages, offer low day trading margins. We also do that as well, but again, I'm not going to push anyone into day trading because it is difficult. But if you want to day trade, you can, and you can do so on low margins. So to give you an idea of how low, I just mentioned the margin on the micro is about 700. If you're day trading it, it's only $100. So you could trade a micro S&P for $100 on a futures account. And honestly, that's really not even that horrible. If you trade the E-mini S&P, you can day trade it for $500 a margin. That's a lot of leverage. And to be honest, most people can't handle that. Most people would blow out their position pretty quickly with that kind of leverage. But people like that sort of thing. It's exciting. Some people treat the markets like a casino. I live in Vegas. I get enough casinos. I don't need that in my life, but everybody's different. People like day trading also because there's overnight risk. Because there's no overnight risk. They can sleep at night. They know that nothing, if they wake up the next morning and all heck's broken loose, it doesn't matter. They didn't have anything on. And so that's nice. But it's also exciting. The whole point of day trading is if you have a trading system that you're using, like a technical system, I should say, you have a specific set of indicators. You have a choice. You can put those indicators on a daily chart, you can put them on an intraday chart, or maybe even a monthly chart. They're probably all going to work almost the same, but with day trading, you're taking those signals and you're getting a whole lot more of them in a short period of time. So in theory, you should make money or lose money faster, right? It's exciting. I'm going to show you how to make it a little less exciting, but maybe hopefully a little more lucrative. So the downfall of day trading is it's probably too exciting. Most people tend to overtrade. They over-leverage. I just mentioned $500 margins on an E-mini S&P. So what happens is somebody has, let's say they have a $10,000 account. Instead of trading one E-mini S&P, which would be probably reasonable, it's a $10,000 account. They can fit 20 of them in there, and that's what they do. So they'll buy 20 or sell 20, and then they wonder why they lost money in their whole account in a couple days. Well, that's why. Unfortunately, we're humans. It's not unlike going to a buffet in Vegas. We don't have to pay anything extra to have multiple desserts. So in trading, people tend to do that. Leverage is free, so they abuse it, unfortunately. And day trading is really emotional because it's so quick and so supercharged. You'll find that the fear and greed that takes over in trading is amplified when you day trade. And again, we're going to show you a way to possibly mitigate that. So in my opinion, the reason that most people lose day trading, aside from the fact that they overtrade and overleverage, that's a given, but the real issue is stop orders. Stop orders are meant to protect people, Every book you read tells you should always have a stop order, right? Because if you don't, maybe one day you get up to go get your coffee and you come back and your account's blown up and you wonder what happened. But if you had a stop in there, at least you know what your risk is and you have some sort of floor as to how bad it could get. That's ignoring slippage and that sort of thing, because stops aren't perfect. The problem with stops is they more often than not get elected exactly when you don't want them to be elected. So if you've ever been stopped out at the low of a market or the high of a market, you're not alone. It happens to just about everybody I've ever known. It's Murphy's Law. That's how markets work, unfortunately. And stop orders, if you've ever played sports, you hear your coach say, don't play not to lose, play to win. Using stops is doing that. It's playing to not lose. But unfortunately, all those small losses add up. And a lot of times what happens also is, if you do get stopped out at an inopportune time, the first thing you want to do is try to get back in. And then you're emotionally chasing the market and getting stopped out and chasing it again and getting stopped out. So I've seen traders lose thousands and thousands of dollars when the S&P is basically trading in a 5-handle range, because they just keep buying the highs, selling the lows, and doing it over and over and over, waiting for something to move. And it's not their fault, it's just how we're wired. It's how humans are wired. So there is a way to day trade in the S&P without using stops, yet still have limited risk and lasting power and all the things that you want your stop order to do for you. And it's by using weekly options. I don't know if you're familiar with what weekly options are, but they're basically options that it used to be 2 or 3 years ago. If we were talking about S&P options, there were options that expired every month. Every January, the third Friday of January, then the third Friday of February. Now they have options that expire every week. Every Friday of every week, there's an option expiring. And the CME has also added options that expire on Monday and Wednesday. So now every week, there's 3 option expirations. Honestly, it's done wonders for the market. This is kind of off topic, but I don't know if anyone trading 10 years ago would probably know that every option expiration, the market would get a little more volatile and some weird things would happen. You don't really see that anymore because there's options expiring every other day in the S&P. So it's kind of smoothed a lot of that out. And I'm going to show you some examples of day trading using the options, but first I just want to talk a little bit about day trading psychology. Nothing gives one person so much advantage over another as to remain cool and unruffled under all circumstances. This is what makes a trader. Like, just being able to not avoid panicking and avoid getting overly excited when you're on a good run is honestly what determines who makes and loses money. Has very little to do with your actual trading strategy, because everybody, when you're talking about trading strategies, everybody's got the same information. We're all looking at the same indicators. We've done our homework. We know what works more often than not. But actually putting that into action and making it work for you is a whole different story, and the difference is emotions. It's not any different than, has anybody made a ton of money in their paper trading account and then as soon as they go live, it's a complete disaster? Yeah. Happens to everybody. It's just, the worst thing that I've seen people do is, if they're a new trader, let's say they've never traded futures before, they open an account, they're excited, they honestly don't have the knowledge of the markets to understand the risks and to understand exactly what they're getting into. So what I see sometimes is people will open an account and they'll make a ton of money right off the bat because there's almost no emotions, because they haven't learned yet that they should be emotional. They haven't learned what can happen when something goes wrong. And that's really the worst thing that can ever happen to a trader, is to make money right off the bat. I've seen traders come in with a $20,000 account, build it up to 80 to 100,000 in a couple weeks, and then never make money ever again because they realize it's a little harder than that. And then it becomes very emotional, and then they're always trying to get that money back that they lost, and it's a mess. So we're all familiar with the emotions. I won't really go into this too much, but fear, the fear of loss or of being wrong is natural and necessary. I've been doing this a long time. I've seen multiple grown men cry. Markets will do that to you. I hate it. Sometimes it's just no fun. But it's unfortunately, if you're playing the game, it's part of it. The trick is not to bring the frustration that you experience with those losing streaks into the next trade, and that's really hard to do. I mean, it's easy for us to talk about it. It's not so easy to do. So the only reason I'm bringing up trader psychology is the use of options as opposed to day trading futures is, in my opinion, the single most beneficial way to eliminate emotions. Well, it's not going to eliminate, I should say mitigate. It will really take a lot of the stress out of it, and I'll show you why. So the two largest obstacles to day trading we've talked about is emotion, and we're going to lump like over leveraging and over trading all into that because it's all the same stuff, and premature stop outs. Those are the two things that really get in the way of day traders. In fact, any type of trader really. But the practice of buying options instead of trading futures outright eliminates almost all of the risk of premature, well, it eliminates all the risk of premature stop outs, and it mitigates the emotional stress. Does everybody know the basics of what a call option is and what a put option is? Everyone? Okay. Yeah.
When you say buying options, are you outright buying puts and calls or spread?
In this particular, like if we're looking to, if just specifically speaking day trading terms, it's just buying calls and just buying puts. So if you think the market's going up, you pick a weekly, an option that expires maybe tomorrow or the next day, you buy a call. We'll go through a few examples. But it's really simple, no spreads. In theory, I mean, you could try to get real fancy with it and day trade spreads, but you probably never make any money. It would be really tough to do that. Yeah.
When you're talking about options, are you talking about options for the future?
Yes. Yes. So when I say, in this, I only deal, like our brokerage only deals in futures and options on futures. So when I say futures, I'm really talking options and futures. And anytime I say options, I'm only talking about options on futures.
But the same theory, since most of us are stock traders.
Yeah.
It's same thing with stocks.
Yes. It is.
It's used for stocks too.
Yeah. You could use the same.
Stocks, I use options all the time.
Yeah, absolutely. You could use the same general ideas in stocks. It's just not my department, so I'm not going to try to pretend like I know something I don't, but yeah, in theory you could use the exact same thing. So by buying calls, if you think the market's going up, or buying puts, if you think the market's going down, and I'm not talking about the monthly options where you spend $1,000 on an out of the money option and you have all this time decay and all this risk. No, I'm not talking about that. I'm talking about weekly options where the option might expire tomorrow or maybe the next day. So you have a couple of days. It's a very short-term trade. You may even be out of it by the end of the day. But the options are going to be relatively cheap because there's so little time left on them. There are times, right now they're actually kind of expensive. So if you pulled up an option chain now, you might think, wow, Carley's a little crazy. They're a little pricey. But it's because the volatility is so high. Usually the volatility in the S&P is a little lower than what we're seeing this week. And in some circumstances you can find, for $200 you can get an option 5-10 points out of the money in the S&P. So for $200, that's your entire risk. No matter what happens, that's the most you can lose. And if the S&P moves 10 points, 20 points in your favor, you could actually make a decent amount of money. So again, we'll show you some examples. But the purpose of doing this, as opposed to just buying an S&P future outright, is you don't have to worry about margin concerns. Most day traders are usually trading beyond their means. And what I mean by that is they're not fully margined. So the margin on an E-mini S&P contract, a full-size E-mini S&P contract, is about 6,000. A lot of day traders are trading one contract per 2,000, 3,000, something smaller than 6. So they're trading a little beyond their means, but what the problem with that is they can't hold overnight. So let's say they put a trade on in the morning. They still like the trade. They still want to be in it, but the market's going to close in 30 minutes. They have to get out no matter what, whether their signal was done materializing, regardless of what's going on, they have to get out because they can't trigger a margin call. So if you're day trading futures, you're always worried about the time. I have to be out by the close. I don't have the margin. If you're trading options, there is no margin. So it completely eliminates that stress. By the way, as just a complete side note, Our day traders are not forced to get out of the market on the close. That it's an option. I mean, unless they don't have the margin. If they don't have the margin, that's a different thing. But we also offer day trading margin 23 hours a day. So even if you don't have the margin, the trick is get out on the close and then you can get right back in an hour later, same trade. So there's some ways to get around it. But anyway, options are simpler and probably a wiser way to do it. So with options, if you're just buying calls and buying puts rather than buying futures and selling futures, you have lasting power. You can lose. I'm not saying you can't lose, but if you lose, your risk is limited to what you paid for the option, and you're always in the trade. The market can always come back and do something for you. If you're in the futures contract and you get stopped out, you're done, that's it. There's no returning. I mean, there is if you want to try to chase it, and that becomes a big cat and mouse game. But with an option, you always are in. You have the lasting power. And you can even hold, if you have to hold it till tomorrow, that's okay too. Yeah.
What different is technical analysis for options on futures and options on stocks?
Well, I mean, the technical analysis you'd probably do either on the futures market itself, not the option, or the stock itself, not the option. Most of it's the same. There's different nuances to the markets, like the futures markets behave a little differently, I would say, but the general analytical tools that you use in stocks can be applied to futures.
How does it behave differently, like on the ES? It's all related to the SPY, the stock, or the future, right?
Sure. So like the ES and the SPY are very similar products. I think we can all agree with that. They have different closing times, though, and that actually creates a lot of waves at the end. So if you've ever traded futures, you know the futures market, it's a little bit, actually it's kind of complicated. The futures market closes 15 minutes after the SPY closes, then it pauses for 15 minutes, and then the futures reopens for 30 minutes, and then pauses for an hour. So it's really weird how they do it. But like a futures trader has an extra roughly hour and a half to square away trades than a stock trader does. And because of that, you'll see weird moves, like in the last 15 minutes of the day in the futures, you'll see weird moves because it's either catching up to the SPY or maybe it thinks something, earnings come out and the SPY is closed. So, I mean, it's really the same thing, but just because of the timing, it can be really different at times. With options, you're also going to have less account volatility and no forced liquidations. You really, really never want to get to a point where your broker steps in and liquidates your trades, but if you're in futures, you can lose more than you have on deposit. So if you are about to lose more than you have in your account, hopefully your broker steps in and prevents that from happening. We don't touch anybody's trades unless if they're about to go negative, then we do, because that just becomes a nightmare nobody wants to deal with. Okay, let's get into the nitty-gritty. So
Options are
sure.
subject to time decay, just like stock options.
Yes, absolutely. And because they're so short-dated, if you're wrong, they can decay really quickly. So, and we will show an example of, and you'll see. So obviously you can't get around the time decay. But the nice thing about that is even if your option decays and you've got a paper loss on it, you're still in the trade. So if the futures market reverses and goes in your favor, it can still come back for you. And a lot of times it does. You'd be surprised. So we kind of already talked about this. I'll just remind you. So there are options that expire every Monday, Wednesday, and Friday in the S&P. And so that allows you to pinpoint your day trading with options. Before the weekly options, before we had options that expired every other day, it was really hard to try to day trade options because you'd have to trade an option that expired in a couple weeks or maybe even a month, and it was expensive, and it didn't move very quickly with the market. These will move really quickly because they're relatively close to the money. So if you do happen to pick the right direction, they can move for you. And they're very liquid. You don't have to worry about liquidity. They're a newer product, but they've been around for a little over a year. Liquidity is picking up all the time. Honestly, I think most of the time during the day, even on the weeklies, even on the Mondays and Wednesdays, the bid-ask spread's about a tick. So you really shouldn't have any problem. And if you're trading overnight, ideally you don't want to do a whole lot of trading overnight because the bid-ask spreads are slightly bigger, but it's definitely not a game changer. I mean, they're reasonable. They're usually 2 ticks, maybe 3 at the most.
You're referring mostly to near the money liquidity, you get either way too
Well, in the S&Ps, in the E-mini S&P options, the liquidities, they're just about 24 hours. If you start looking at some of the other markets, they get thinner, out of the money. Yeah. ES is pretty liquid all the way around. I never have any problem. If you do see a wide bid ask on the E-mini S&P options, it's usually because like maybe there's huge volatility in the after hours. Sometimes the market makers will pull back and you will see that. But more often than not, if you throw an order out there at a fair price, they'll fill it. They're pretty reasonable.
How much typically do you have to leave on the table when you execute a trade and get out of it on the market?
In a market like the E-mini S&P that is so liquid, generally, honestly, you might have to give up a tick. It's not really a big deal. If you're trading something like coffee options, you might have to give up a couple $100 getting in and out on something. But on the E-mini S&P, it's really kind of, it's not a big deal. It's not something to worry about. So in a nutshell, trading options is kind of like poor man's day trading. We have limited risk, we have lower risk, and because the options aren't going to move nearly as quickly as the futures, your account volatility, like your profit and loss or your account balance, isn't going to move nearly as quickly as it would if you were trading futures either. So you could call it poor man's day trading, or you could just call it maybe a risk-averse type of day trading. A lot of people ask me, when I bring this idea up, a lot of people ask, do weekly options move enough to make or lose money? And I agree that if we're talking about monthly options, my answer would have been no. But with the weekly options, yes, and the difference is you can get strike prices that are closer to the money, so they will react if the S&P makes a move. Just for reference purposes, an at-the-money option has a delta of 50%. That means if the S&P future moves 10 points, the option will move 5. So right there, you've cut down the volatility. Even if you're trading at the money options as opposed to a little out of the money options, the profit and loss volatility in your account is already cut in half, which is a nice thing, trust me. If you choose to trade out of the money options, obviously you're going to have a lower delta, but your risk is also going to be lower. So if you're a conservative trader, you only want to risk a couple $100, there's nothing wrong with that. You can pick an out-of-the-money options, especially when the S&P is moving like it is this week. If you happen to be right, I mean, timing has to be pretty good. Your direction has to be right, obviously. They're not just going to give you money. But if your signals work at all, you can peel a little bit of money out of the market. So this, it's going to be hard to see. I was hoping it would be a little bigger than that. The point of this slide is this is just an option chain of the E-mini S&P. This was actually a very volatile day. This was last year in, I think it was January or February if you remember when the S&P was going bananas back then. But it's just as an example. You can look at the high and low of a particular day. Like I'll just pick out the 2810 that's highlighted here. The low of the day on this option was 185. So each point in the S&P is worth $50. So that's roughly $100. We'll say the low of the day for that option. The high of the day was 10 points. Each point's worth $50, so we multiply it by 10, that's 500. So you can see these options can move enough to make money or lose money, if you're wrong. But it goes from 2 points to 10 points. You risk $100 to make 500, well, you ended up being 400 after all is said and done. So you can see they can move enough. And in quiet markets, you'll notice that the options get a little cheaper. You're probably not going to see an option quadruple in value like you see like that, but they can move enough if you're right. So there's plenty of profit potential, but limited risk. Yeah.
If you do want to risk more and you go deeper in the money, you have more potential to win.
Sure.
Right?
Yep.
Can you talk a little about that one?
Sure. Yeah, so I probably wouldn't recommend using in the money options, but I think an at the money option is reasonable in circumstances like if an option's expiring this afternoon or tomorrow, you can get an at the money option for like $5, $6. So. Yeah, with the short time, I think you're better off just buying at the money. I mean, the thing is, the decay is going to be really, really quick if you're wrong. So, like if you buy a call option and the market tanks, it's going to just go up in pixie dust. So you don't want to spend a ton of money on it, but at the same time, you want a foot in the door and you want it to be reasonable. So the E-mini S&P is by far the most liquid and efficient to day trade with options, but you really could do it with crude oil. There's weekly options in crude oil. Whoops, I got ahead of myself on that one. There's weekly options in crude oil. The 10-year notes, they're not crazy liquid, but they're really, really cheap. So I'm not sure you can day trade them, but you could swing trade the options on the 10-year note. The euro does have weekly options, so if you wanted to play the euro, the volatility in the euro is really low right now, probably not a candidate for day trading, but there are times when the euro is moving that it might be. So just keep those in mind.
The crude oil, is it almost or anywhere close to as good as the ES?
Liquidity?
Yeah.
No, it's getting better every day. A few months ago, it was kind of, you pull up a chain and you just see spots on the bid and ask, like there really wasn't much going on. Now you can, if you pull up an option chain, you'll see bid asks on just about every strike. They're probably 3-4 cents wide a lot of the time. Some of them, it depends on which month or which week you're trading. So you want to be a little more careful with crude, maybe if you see a real good opportunity, but they're getting better every day, so keep checking in on them.
Is that because of seasonality, or is that just, just a part of trading crude right there? That
Well, crude oil itself is a less popular market than the S&P because everybody knows the stock market and they're familiar with it. So if they're going to move from stock trading to futures trading, that's the first thing they go to is the S&P. Crude oil is probably the second or third thing they go to, so there's just a little less interest there. But also, the weekly options in crude oil are much newer. They didn't even exist about 6 months ago, so they're still trying to build up their liquidity. Yeah.
Is the futures options you're talking about the SPX?
No, so the SPX is a stock market product. So the futures that I'm talking about is the E-mini S&P. It's basically the same thing, just the future side, not the stock side. So they're very similar. All right. So the great thing about trading futures as opposed to options, which I'm switching it on you a little bit, is it's really simple to calculate how much you might make or lose on a trade. Once we bring options into it, suddenly they're not black and white answers. It's not a simple math formula. Options are a little more difficult because you're dealing with time value, you're dealing with volatility, you're dealing with emotions, you're dealing with things you can't predict in the future. So you really can't calculate what your potential profit or loss might be on an option at any time before expiration. If you want to say, at expiration, if I hold the option, what will my option be worth if the futures market is here? You can do that. But anytime before expiration, it's impossible to know what the P&L might be. We can kind of guess and estimate, and we can usually guess pretty well, but it's not the gray, there's a lot of gray areas. It's not the black and white that futures traders are accustomed to. So that's one thing that holds people back from trading options, but I don't necessarily think it should. I think if you trade options a couple times, you'll get a feel for it and you'll have a better understanding of how it works. Option trading is kind of one of those things you can read a million books and it doesn't really sink in until you actually do it.
Speaking of books, do you cover any of what you're talking about now in that higher probability commodity trading book?
Honestly, not really. Yeah, no. This higher probability commodity trading is kind of focused more on swing trading or position trading, not day trading. So, no. And actually, when I wrote that book, weekly options didn't even exist. So this is all just kind of new stuff coming up.
Yeah, but I just haven't had time.
Yeah, that's all right. Okay, that's a great opportunity, or a great question. Yes, for day trading purposes, no, but for position trading, yes. We do it all the time. For example, we generally like to sell options as opposed to buy them because most options expire worthless. So what we'll do often is we'll pick an option that we want to sell, and then we will use a weekly option that expires sooner than the option that we're selling as a hedge, just to kind of take the catastrophic risk off the table. So we do that a lot. Okay, so this is kind of an example we're going to run through here. This is a day trading setup. Somebody that's a counter trend trader might look at this and say, I want to go short the S&P futures here. That would be one way to play it. Or the other way would be to purchase a put option. So obviously if you sell a futures contract and place a stop, you're going to make or lose money immediately. It's going to be simple math, all those good things. And if you're right, you're probably going to make a lot of money. quickly, so that's great. But the problem is it's not as easy as it, in reality, it's just not that easy. You're probably going to get stopped out before it actually goes down if it does. So buying an option might be a way to go about it. In this particular case, this trader might have looked to the 2680 put option right here. It's obviously out of the money. I mean, we're not trading an at the money option here. But the cost is only $132. So no matter what happens, the most that trader could ever lose is $132. And this option expires in 2 days. The 2 DTE, that means it expires in 2 days. So you have roughly 2 days for the S&P to drop. It doesn't have to get to your strike price. A lot of people, that's kind of a misconception. People that have never traded options think that the market has to get to your strike price for you to make money, and that's just not true. It would be nice if it gets to your strike price, that's great, but it actually, believe it or not, you could make money possibly if it doesn't get to your strike price. And then I'm going to confuse you even more by saying, if it gets to your strike price but it takes 2 days to get there, you actually still won't make money. So it's a little bit tricky. But in this situation, the point is we're trying to day trade. So we want, even though this option expires in 2 days, we want some sort of down move to occur today, or preferably tomorrow at the latest. And really that's all that has to happen for this option to increase in value. If it turns around and moves the right direction and it does it sooner rather than later, you should pick up a few dollars on the option.
What happens if it expires in the money?
If it expires in the money, you will get assigned a futures contract, and I would never recommend anybody do that. I mean, you can. It's not the end of the world if it happens, but if your goal is to day trade with low risk and limited risk, then that's probably not what you want to do. But it's not the end of the world. If you let it expire in the money at 1 o'clock Pacific time, if your option's in the money, the exchange will automatically exercise it.
Is it the same kind of fee as if the stock
It is.
expires in the money?
Well, no, there's no fee, and you don't have, like in stocks, if you get exercised, yeah, I think you have to put up some giant capital requirement and all that stuff. That's not the case. All you have to do is have enough margin in your account to hold the futures contract, and they'll charge you a commission. So a couple dollars in commission, that's about it. So this option was purchased near the low of the day. A few hours later, okay, I think I already explained that in the last slide, so I'm going to skip forward. We're starting to run a little short on time. So when you choose a strike that far out of the money, remember we did the 2680 put. It was a good 40-ish points, maybe 30-ish points out of the money. I didn't calculate exactly. But it's not going to move that much. If the S&P ebbs and flows, your option's not going to change value much. It's going to erode a little bit. It's not going to go move it. If the market moves in your favor, you're not going to make a ton of money. So you do need a decent sized move for that to pay off. In this particular case, 15 minutes after the trade was put on, the S&P's trading about 3 points lower, not a big deal, normal ebb and flow. A futures trader would have been up $150, but an option trader would have only been up $27. So you can see the difference. Futures trader, you're going to make more, but you're also going to lose more. Option trader, you're not going to make a ton of money on a small move like that. You need a decent sized move for it to pay off. But what we were talking about before is you have lasting power. So let's fast forward to 4 hours after the trade. And remember we bought a put, so we were hoping the market would go down. 4 hours later, the S&P is actually 14 points higher, so the market went the wrong way. So our option obviously erodes pretty quickly, right? We paid $130 for it. Now it's worth 50-something dollars, so it's lost almost all of its value. But we're still in the trade. We don't have to get out if we don't want to. The market can always come back. If you were trading futures, though, we're down $82 on this option. It's no fun, but it's not the end of the world. A futures trader would be down $700. We're starting to talk about real money there. And that futures trader would have to decide, do I want to continue to risk more than my $700? Or they may have been stopped out. $700 might have been kind of their limit, and they might say, forget it, I'm out. The option trader that's only down $80 might think, you know what, I still think the S&P is going to go down. I'm still getting sell signals. Instead of getting out or instead of hanging on to the strike I got, how about I lock in my loss, take a small loss of $80 roughly. I'm kind of rounding, $100. Lose $100 on this one. buy a new put with a higher strike, hoping that if the market rolls over, we can make some of our money back faster and be in a better position. Once we do that, we lock in a loss of